Before we talk about accounting standards, John, you tell me about the GAAP hierarchy. In this case, let's talk about the fair value hierarchy. I know it begins with a concept called observable inputs. What does that mean?
The issue of the fair value hierarchy, Becky, was designed to give, for want of a better word, a roadmap to users in the development of their fair value solutions. They created a hierarchy that has three separate levels. And for want of a better way of saying it, level 1, level 2, level 3. Levels 1 and 2 are observable input levels. Level 3 is unobservable. The hierarchy goes from level 1 to level 2 to level 3. If you can identify a value that would be based on an identical measurement for the item, it would be a level 1 input. Now, there's few level 1 inputs because you're talking about identical. So identical could be publicly traded shares of stock. Identical could be a commodity inventory product. But there's not a large array of items that are identical. But if you have an identical fair value measurement, that's perceived to be, or it's considered to be, a level 1 input. That's observable.
Well, that makes sense. But what's the difference between level 1 and level 2 inputs?
Level 2 inputs are observable for everything else. So where level 1 is identical, level 2 looks more at market factors, such as interest rates, risk premiums, such as inflation issues, factors that can be looked at to develop a fair value, frequently based on some type of valuation model. So you'll put inputs into the model, you'll generate a solution. Those are all observable, so they fall within a category of level 2 inputs.
Well, as you said, the guidance emphasizes the use of these level 1 and level 2 inputs, but in some situations, you've got to move to unobservable inputs, don't you?
The vast majority of valuations that have been performed during the last couple of years have fallen in a level 2 area. One, because level 1 inputs, it's hard to find a lot of identical, and the recommendation, if not the requirement, in the ASC Section 820 is that we make use of more observable inputs than unobservable. Now, realistically, there are some situations where there's not an observable value. If you take the example of an asset retirement obligation, you have to record the ARO at fair value, but AROs don't trade. So coming up with a observable level 1 or an observable level 2 is virtually impossible, which would lead you to use a level 3 input, which would be based upon the entity's specific assumptions as it relates to how the marketplace might use the asset. But the assumptions are developed by the entity itself as it relates to that. So level 3 inputs are non-observable or unobservable, and they're based upon assumptions that the entity makes as to what the marketplace would use these for going forward. So the hierarchy, again, level 1, level 2, level 3, part of the problem that we faced, certainly during calendar year 8 and much of calendar year 9, was the fact that we had a standard that said to look for active markets to perform the valuation, and in many areas there were no active markets.